Maxey. Okay. Well, let's kick it off with some quick intros. Matt, why don't you go first?
Good morning. My name is Matt Maxey. I am the Chief Innovation Officer at Synovus Bank. We're a $57 billion regional bank, commercial bank in the southeastern United States.
Okay, Mike?
I'm Mike Cagney, one of the co-founders at Figure.
Okay, and Wade?
I'm Wade Peery. I'm the Chief Innovations Officer at FirstBank out of Nashville, Tennessee. We're about $13 billion.
Okay, so let's get right into it with the question of the day, why the future of payments will be blockchain-based. So Mike, I'd like to start with you. When you say payments should be blockchain-based, I mean, I think most people have a rudimentary, at least, understanding of the blockchain, but what do you exactly mean?
Sure. So when you think about blockchain, it does two things that are very, very powerful, which is one, it allows you to displace trust with truth. So it allows you to create a native digital asset where you can look at that asset, you know the provenance, the composition, the ownership. So there isn't any attestation, trust me, this is really a loan, or this is really equity in a company, or this is really US dollars. I can look at that and I know that it is true. The second thing that blockchain does is it allows you to transact bilaterally without counterparty risk. So if I want to sell you Figure stock, for example, it sits in my wallet, you have stablecoin in your wallet, we face off directly, and the stablecoin gets registered to me, the equity gets registered to you, we transact without counterparty or settlement risk. So when you intersect those two things, you can create marketplaces where you're agnostic to your counterparty. And this is incredibly powerful in financial services, because if you think about financial services, all it is essentially intermediated marketplaces. So think about how we trade stock, for example. DTCC sits in the middle as the registrar. We have an exchange that operates, and then we have introducing and clearing brokers on every transaction. Blockchain, you don't need that. Effectively, you can go to a decentralized exchange and counterparties can face off directly. They don't need to know who each other are because of the displacement of trust and truth and the elimination of counterparty and settlement risk. And not only do you eliminate DTCC, you eliminate the NASDAQ and the NYSE, and you eliminate all the introducing and clearing brokers, the Schwabs and the Robinhoods of the world. You don't need them in that context. Equally large and impactful is payments. So if we think about interchange, Visa, MasterCard sit in the middle and they own the rail. You have your issuing bank, issuing processor, merchant bank, merchant acquirer. Blockchain, I can simply take a wallet with stablecoin and transact bilaterally to the merchant, be able to pay the merchant real time and not have to go through that infrastructure or that friction that necessitates the issue that we have today. So the predicate of all this is around stablecoin. And obviously stablecoin's been in the media, certainly with the UST collapse and all the issues that came around that. But until recently, banks weren't doing stablecoin. And what happened last year is Figure did a transaction where we had a bunch of Figure employees take their stock. So one of Figure's companies, Figure's a holding company. We have a bunch of blockchain businesses under Figure. One of our businesses is called Figure Equity Solutions, and we have 500 companies that run their cap table on blockchain as part of that company. And what we did last year is we had a set of Figure employees take their equity in their wallets, attach it to a decentralized exchange, a limit order book, and put their stock up for offer. And we had institutional investors come in and bid on that stock. And for 7 days, for 24 hours a day, we just ran an open marketplace for our stock, and it just floated. Fortunately, it floated up, but it floated wherever it wanted to float. What was seminal about that transaction, first, it was the first time anyone's run a marketplace for blockchain native securities, and we did that through our broker-dealer and our ATS exemption. But more relevant to that transaction was the institutional investors that came in and bid on that stock bought stablecoin directly from New York Community Bank. And it was the first time that a bank has issued stablecoin to support a blockchain transaction. We did this on a blockchain called Provenance. Provenance is the only blockchain that banks have actually transacted on because of some of the natures and characteristics of that blockchain. But what they did that I thought was very, very prudent was they didn't say, well, this is going to be our stablecoin. So they didn't take the approach that Silvergate and others are taking, or JP Morgan with JP Coin. They created a token called USDF. And they said, what we're going to do with USDF is we're going to allow any bank that wants to be part of USDF to be able to mint, destroy, and transfer USDF. And we'll build a set of rules for reciprocity of USDF. And so what they did as part of that transaction is two things that are very profound. One is they created an ability to create unlimited supply of stablecoin to support decentralized transactions on blockchain. So today, historically we think about USDC and USDT as primary stablecoin to support crypto transactions. There's a finite supply of that. Excuse me, because you're taking essentially the general credit risk of the issuer of that coin. So USDF, having a bank-issued stablecoin, you now have unlimited supply of stablecoin to support these decentralized transactions where it's bank-backed. The second and more relevant impact of this is USDF is essentially a payment network. It's a 24/7, 365 rail of which banks or customers of banks can move money to one another. And this addresses ACH, addresses interchange, addresses cross-border remit, and SWIFT. It has a massive, profound ramification to the broader payments ecosystem. And that's where we're super excited to support with technology the USDF consortium that's been put up, of which both these folks are members of. But what's key about this is it's a bank-owned network. So the banks own it, and the banks are building a payment infrastructure, a payment ecosystem that I think is ultimately going to crowd out every other method of moving money.
Okay. So Wade, I want to turn to you. You're a banker, and you work for a mid-sized bank. What got you interested in blockchain, and why sort of bring it to the bank? What brings the bank as a business case for blockchain?
So, a couple of things there. I'll say this as lessons learned. Haven't been in this business a really long time. I was on the sidelines as a banker and watched the first wave of Fintech happen, right? And our business was decoupled and peeled apart, repackaged and resold. And so banks didn't do a lot, right? We kind of sat on the sidelines. And as you think about, and then I've seen the internet come to be in the banking business. I've seen cell phones evolve to smartphones. In my view, blockchain is going to be as disruptive and beneficial to the industry as those things were. And so sitting on the sidelines is not an option at this point. Right. The technology, the value of the technology is there. It will make things better for customers, and economically better, safer, faster. And so we just see high value of the tech. So we want to work, we want to lean in here and be a part of leading that.
Right. So Matt, was there a similar thing with you guys? I mean, what is when you're thinking about joining the consortium, the USDF consortium, how did you present it to the bank there as an opportunity? Yeah,
similar to Wade, we looked at it as very much the future of core parts of banking infrastructure. You look at the core technologies that we operate on today and the payment rails that we use today that connect us between merchants and businesses globally through SWIFT, the P2P networks. And so we very much view this technology that we use in the USDF consortium and other models like it as a part of finance. And so we're approaching this very much from an R&D perspective, incubating different use cases and try and learn, perfect, try again. The other side of that, as far as why we decided to join the consortium was, look, we want to be a part of helping establish a new framework, a better way to lean in with other banks and together, along with our regulating partners and those that we interoperate with on a daily basis on behalf of our customers, we want to stitch together a strategy that improves experience, that improves economics, that powers finance for generations to come. And so it was really both pieces. Similar to Wade, we see it absolutely as a part of the future of finance, and we want to participate, but we also want to lead and help stitch together that strategy and formulate what that should look like for banks here in the U.S.
Right. So, Mike, I want to turn back to you. You did mention it. We had the Terra Luna meltdown earlier this month. It was called a stable coin, just like yours is called a stable coin. Very different, I know, but why should people listening to us today, why should they consider your stablecoin a completely different animal to Terra Luna?
So it's not my stablecoin, it's their stablecoin. So that's the first thing.
Gotcha.
It's a bank-issued coin, and effectively, the bank is behind that, the deposit's behind that, our general view was that you needed the banking. So one of the interesting contexts when you think about DeFi, a lot of people look at DeFi and they say, well, DeFi is going to disintermediate the banks. There's no role for banks in DeFi, et cetera, et cetera. We don't have that view at all. We think blockchain is very, very much an infrastructure that's powerful for banks to leverage and utilize. And so it's important for banks to play a role and be participating in this. And this is one of the big hurdles that we have, which is the last mile on this is getting broad regulatory buy-in to the construct of USDF. Because today, if you look at what Yellen put out, President's Working Group on stablecoin, USDF is exactly what she said it should be, right? A bank-issued coin done in a regulated fashion with KYC AML infrastructure behind it. It's all the things that it needs to be. And I think that what you're going to see in the near term is, take decentralized exchanges, for example. Today, US funds can't trade onshore on DEXs because they don't know who the counterparty is. In the context of USDF, you can have a USDF Bitcoin or USDF ETH DEX, and then you can bring that activity onshore and support that, because the whole premise of USDF is that it can only go to a KYC wallet. And so there's enormous amounts of use cases, in particular the programmability of USDF, that I think are going to open up applications here. But at the end of the day, it's really core to the banking ecosystem. And I think one of the things the banks recognize, all this discussion about central bank digital currency, CBDC, is the banks need to get in front of that, because if the Fed builds a CBDC, that's actually the end of the banking system. So it's an existential threat that the banks need to be in front of.
Right. Is that something that was a consideration for you guys when you decided to join the consortium?
Yes, I mean, think about it. It starts at the banking system level, not the industry level in my mind, because we have to understand that private companies creating currency takes away the Fed's ability to manage monetary policy, and we can argue whether we like that or not, right? But the real challenge is just what Mike talked about. You have a federal government and you have a commercial banking system. Commercial banking systems dependent on deposits to fund loans, provide credit to the communities, right? And so if you bring on a CBDC and it's issued by the government and held in a wallet, then we have a tremendous problem, and our system doesn't work because we can't fund those loans, and so we break everything. So certainly.
So your perspective then is that the Fed probably won't issue a CBDC? Is that your thought process?
So here's the way I would think about that. And Mike said we're at the last mile. So what we've solved at this point is the ability to take a US dollar, a fiat dollar, bring that on chain as a digitized token, move that on chain, build applications on chain. What that in effect does is it leaves everything intact, right? Our system is intact. We don't have to change regs. We don't have to change structure. So from my view, we have solved that. This can solve that.
Right. Okay, so then Matt, with USDF was, as far as how your bank sort of views this, I'd love to kind of get a sense of, like, is it the stable coin piece that's the most attractive? What was the most attractive piece for you to jump into USDF?
Yeah, I think it was two things. One was the ability for us to have a new framework, what we refer to as the undercarriage of the bank infrastructure, that we can begin to give a fresh perspective to customer problems and opportunities, number one. And then number two, as I mentioned, to gain learnings and perspective on the opportunities around the new tech, right? We talk about this a lot internally and in our peer groups, trying to figure out, okay, what does the future of finance and banking look like, right? And what role do banks play in banking 15, 20, 30 years down the road? And I think, the second item is really about understanding, will we be able to not only participate in that future environment with the new tech, with the new processes, whatever those may be, but are we taking active steps now to make sure that we're looking for those opportunities, that we're bringing value to our customers along the way, but we're also building for our banking system and the bank of the future as far as Synovus is concerned. So it's very much a forward-looking while we're also creating value in the here and now, and doing that together in partnerships with our risk partners and our regulators, other banks in the consortium. Those are the primary areas and reasons for why we see a lot of value in this.
Right, right. So, Mike, you said it's not your stable coin. What's the governance? Who controls USDF?
The banks. So there's a board for the USDF, but it's a bank consortium. So it's owned and governed by the banks, which we think is important. And it's, you don't want to underplay how relevant this is to changing the banking approach to payments. And that, if you take interchange, for example, and you think about merchant acquirers, today you have Square, for example, merchant acquirer, and then takes high frequency data, provides lending into those merchants. What a bank can do in this context, and what Wade's doing right now with FirstBank, is they can take USDF, integrate it into their mobile solution. So we're working with both FIS and Jack Henry to do that integration, so it's part of core banking applications. Your customers now have USDF as a payment method. The bank can go to its business customers and say, look, I'll be the merchant acquirer here. So I'll cut you out of that 100 to 300 basis points of interchange expense, and I will set you up to accept USDF as a payment rail from our own customers. And starting with that and building out. What you do in that context is the bank becomes merchant acquirer. The bank will take that high frequency data and they can become merchant lenders. So not only do they disintermediate Square, they disintermediate Square Cash too. And they're doing that through this payment rail. And so it is a core utility into the banking system. And that's why the banks are governing this.
So then where does that, it's a new payment rail. So you guys, I'm sure you have existing credit card businesses with one of the major networks. How do you view this, the new offering, versus what is already in place? What are the advantages? Is it just a cost advantage for you guys?
I think it's cost advantage to the bank, but I think it's even a bigger benefit to think about small business who today would pay 3% to accept a payment. And if you really step back from that and think, I'm giving up 3% of my gross margin to take money for what I just sold you. And so if we can cut that cost to 1%, let's say, there's your win, right? And so as we think about the foundational piece of this as a payment rail, and we're developing and have actually developed and running in a non-production environment today, inside of our mobile solution, the ability for you and I to pay one another. And so the next step in that is the merchant piece.
Right,
so we think, again, even the P2P piece is a huge cost win for the bank, which just lets us give back more and really engage our customers more.
Right.
Yeah, and I would say in addition to that, optionality is key, right? The ability, for banks that have the merchant portfolios in the acquiring business, right, having optionality, because we won't be the only ones that are in that market bringing that new capability, that new tech, that new price point, and the attractiveness around that to the market, right? So it's about being ready, it's about finding ways to power and bring economic value to our merchant base, while at the same time that we have optionality on the table in terms of the offerings that we have.
Right. So what's a product roadmap look like for you guys? I mean, do you have a sort of first product that you're going to go to market with?
So right now we're having conversations with multiple internal stakeholders on that front. We see a lot of value in our commercial business in B2B or B2B2C models. We have a large commercial and wholesale business, specialty finance. And so, allowing those partners to pay themselves within our own ecosystem with much less friction, high levels of data is important. And another aspect of that is to kind of look at it more broadly and say, what are those future innovations that we can have, right? We absolutely have a roadmap that we're building, we're negotiating out as we bring to bear the technical capabilities that go along with that. And we'll continue to have those conversations internally within the bank.
Right. And Wade, what about, you were chatting about a P2P payments product. What's on your roadmap?
So we, foundationally, that's step one. The P2P side and the merchant side, and like Matt, long list of ideas and vetting thoughts around that, but just think about use cases, think about supply chain finance. What we haven't said here this morning is what's so different about USDF is the ability to program, right? So I can now program money and I can cause things to happen as we agreed they should happen. So supply chain finance has a purchase order, an invoice, a shipment, a payment. So now we can take multiple processes that either parallel or sequentially run that actually ultimately end in a transaction and program all those things to happen, because we'll have truth right along the way. We'll know things happened as they should have and money exchanges as it should have. So the universe of use cases is practically endless, and you can really look at everything we do today.
I know it feels like to me finance is about to get really interesting. I mean, would you agree, Mike? The programmable aspect opens up, as you said, infinite possibilities.
Yeah, I think it's the biggest differentiator. A lot of people talk about FedNow, and they say, well, why do you need USDF if FedNow comes to market? The programmability, excuse me, is the key element of that. And take supply chain finance, for example, or payable receivable financing. One of the issues you have there is around fraud and double pledging of invoices, misdirection of payments. So imagine a blockchain AP/AR infrastructure where all the invoices are digital, they're signed by both parties, the payer and the payee, and then if I come in and I encumber that invoice, I lend against it, I factor it, whatever it might be, then when it's paid in USDF, the USDF knows to go to me. I don't have to reroute the payment instructions or rely on the payer or the payee to actually compensate me back. And so you have an unlimited supply of applications off of this, and I think this is the most transformative thing that's happened in financial services and maybe forever. The infrastructure and the disruption, you're talking about trillions of dollars of an existing interchange ecosystem that's going to basically be migrated onto blockchain.
Yeah, there's a couple other maybe I'll throw on the stack. Loan syndications and participations is another one, or complex asset purchases and sales on the wholesale side, bank to bank, and having infrastructure and the programmability aspect of the contract on chain allows you to do things like just-in-time, virtually real-time interest rate calculations, right, for a payoff or an exchange of the asset. So, all of those processes in the banking world today have high levels of friction and closing, and so. Just in the here and now, there's quite a few areas where this type of technology can be very accretive.
Right. So then, how are you trying to grow the consortium? I mean, it feels like it's still in its fairly early days. There's thousands of banks. How do you get everybody? Like, what are the conversations like when you're talking to your banking buddies?
Well, they vary. I mean, I think folks are in different places in terms of how much understanding they have around blockchain.
Right.
So it generally starts there. And I think what will turn this to a really good flow of banks is use cases. We're going to have to get those use cases out there. We're going to have to get through the regulatory conversations. And I think when those two things happen, and suddenly I have a competitive advantage, I don't think that'll be it'll be a long wait for to see banks jumping.
Right. Okay. So then, what we have? I want to touch on regulators, because they're going to have the ultimate say here. And you said Janet Yellen said that this is the framework similar to what you guys have done. How are you? What are conversations going like with regulators? How are you engaging with them? Well,
Yeah, and it's also about creating transparency and trust, right? And painting the picture for the future of finance, but not just the future, like we've talked about, just recently, the practicality and the power that can come with a network like this that's bank-run, bank-owned, the innovation that can happen, right? Hitting on the innovation piece is so key. There's a lot of discussions going on now in the regulatory world about innovation and how they think about that. And so we feel like this consortium is well positioned to play a large part in that. And so we're being open and transparent and iterating through rules and discussions on risk and just lots of good conversations happening on that front.
Yeah. The key is you've got hundreds of billions of dollars of stablecoin that exists today, right. And it's in an unregulated or primarily unregulated fashion. And so it's an opportunity for the regulators to step in and actually provide safety and soundness, BSA, AML, infrastructure, all the things that they need around stablecoin. So if they don't act and they don't give the green light for this, they're effectively implicitly allowing that sort of shadow stablecoin ecosystem to exist. So it's an opportunity for the banks to step in and provide a lot of transparency, accountability, and visibility into the ecosystem that's needed.
So in some ways, we're talking about a complete rewiring of the way banks work. Who's going to ultimately be displaced here?
It's not so much a question of displacement, it's a question of reallocation. So you can start at the center of the network. So you look at Visa and MasterCard, you say, well, you don't need that interchange network anymore. That doesn't mean there isn't a key role for Visa and MasterCard to lean in and play within that blockchain construct. You think about the issuing banks. Chase, biggest issuing bank in the country, it loses that revenue, but that doesn't mean there isn't a role for them to play in terms of key management, for example. So I think what you're going to see is a reallocation of the roles that people play within the ecosystem, but it's going to be significant because you're not going to need that old interchange construct with 5 parties.
But there is a chicken and egg problem, right? Where you've got, the incumbent system is very well entrenched. I mean, there's tens of millions of merchants throughout the world. There's billions of credit cards and debit cards throughout the world. How do you kind of navigate that?
Well, to Wade's point, if you're a retail merchant, you're running a 10% profit margin. 3 points of interchange is a big deal, right? And so I would never underestimate the desire of merchants to move off that transaction tax. And so it's really around how do you get consumers to adopt it, and that's where I think the banks are key, implementing it into their core mobile solution, their core banking solution, so it's a default payment method. And the reality is, you should never know that you're in USDF. You should never know you're transacting on blockchain. It should just be money to you, right? You see it in your wallet, you go to the merchant, you transact. And there's one other really important benefit to the merchant context, and especially for both of these banks, because they're very community focused. You're keeping the money in the community, right? Right now, that 3 points doesn't go back into the community. It's not reinvested, so it's going out to the issuing bank and the ecosystem around that. So being able to keep the money local, I think, is a huge value prop for everyone.
So is this still going to be, if we're talking about the card payment network, I mean, are we still talking about a Visa or MasterCard branded card? Because again, the merchant has to accept, he's not going to accept an USDF branded stablecoin card just yet.
So I don't think that the merchant necessarily needs to know that it's a USDF branded stablecoin per se. I think today the merchant has 20 or 30 different payment methods it can accept, everything from PIN debit to credit. And so I think what this is an incremental rail within that. So I don't think there's an overhaul of point of sale infrastructure or hardware. I don't think there's a card anymore either. I think everything happens biometric off the phone.
Sure.
And so you're dealing with cardless, pinless, and codeless transaction opportunity. But I think you can leverage the existing point of sale infrastructure to get this to work.
Right. So I'd like to close with maybe Matt and Wade. Is there a time schedule you're looking at here? I know it's not completely in your hands, but are we going to see a product in 2022? Are we going to, what's sort of the estimated time of rollout of a product?
So I know Wade and his team are a little ahead of us in terms of the product readiness and their discussions and ready to go. We've asked that question internally. There's lots of variables. I would say, probably within the next 12 months or so, potentially to be minting and burning on the network for us. But that's going to largely depend on the partnerships and the discussions with our regulating bodies. Right. Completely implementing our tech components and connecting into the chain, and we're already running those kinds of tests today in a walled garden, full test environment. So that would be my estimate. But to your point, there's lots of variables at play on that.
Right. Wade?
So from a technical standpoint, yes, I think as Matt said, it depended on how long it takes us to get the regulatory bodies comfortable with our risk framework. And so those are the pieces I would say are kind of unknown in the timeline. But it's not a monumental work effort. I mean, it's actually not been a heavy lift on the technical side at all. So I'm very pleased with that.
That's interesting.
You could see
not a heavy lift, you say?
Potentially. Yeah.
Mm-hmm. Interesting. Okay, well, we'll have to leave it there. It's an exciting new world that's coming. So give them a hand. Thank you very much, gentlemen.
Thank you.